Imagine you're a landlord who bought property at peak prices around 4 years ago, counting on those juicy pandemic-era rent hikes to last forever. Fast forward to 2025, and you're offering 2 months of free rent, waiving fees, and practically begging tenants to move in. Welcome to the new reality in America's most dramatic rental market crashes. The rental market is flipping upside down, and landlords are sweating bullets. While the national median rent has plateaued at around $1,394, down 0.8% year-over-year as of September this year, some cities are experiencing full-blown rental apocalypses. We're talking double-digit declines that have landlords questioning every life choice that led them here. The culprit? A perfect storm of overbuilding, shifting migration patterns, and economic uncertainty that's rewriting the rules of real estate investing. So grab your calculator and your Pepto-Bismol, because we're counting down the 10 U.S. cities where rent is crashing harder than a lead balloon. We're starting at number 10 and working our way to the absolute worst offender, the city where landlords are watching their investment dreams evaporate in real time. Number 10. Columbus, Ohio. Columbus is experiencing one of its largest rent drops in recent history, with asking rents down 3.5% as of May this year. This might not sound catastrophic compared to what's coming, but for a Midwest market that typically sees steady growth, it's raising eyebrows. The city has been on a multifamily construction binge, ranking in the top 10 nationally for new apartment permits. All those gleaming new units hitting the market simultaneously has led to fierce competition among landlords who suddenly have more supply than demand can absorb. Property owners in Columbus are discovering that tenants have options, lots of them. The market has shifted from "take it or leave it" to "please, pretty please, sign this lease." Concessions like discounted deposits and move-in specials are becoming standard operating procedure. Number 9. Nashville, Tennessee. Music City's rental market is hitting some sour notes. After years of explosive growth fueled by people fleeing high-tax states, Nashville's rent party has officially ended. The median asking rent has dropped 4.5% year-over-year, leaving many investors who bought at the peak wondering if they miscalculated. Nashville became a victim to its own success. Everyone wanted a piece of the action, leading to a construction boom that flooded the market with new apartments. The city was adding units faster than new residents were arriving. Classic oversupply economics. Those who purchased rental properties 4 years ago are now dealing with negative cash flow scenarios they never imagined. Property taxes and insurance premiums continue climbing while rental income drops. It's the nightmare scenario every real estate seminar conveniently forgets to mention. If you still think your city got off easy, just wait. It gets much worse from here. Number 8. Phoenix, Arizona. The desert heat isn't the only thing dropping in Phoenix. With a 6.2% year-over-year rent decline, the Valley of the Sun is proving that what goes up in a housing boom can definitely come crashing down. Phoenix was ground zero for pandemic-era migration, with remote workers flocking to Arizona for lower costs and sunshine. Developers responded by building like there was no tomorrow. But tomorrow came, and it brought 22,000-plus new apartment units in just a few years. When migration slowed and people started questioning whether 115-degree summers are really worth it, the oversupply became glaringly obvious. Property owners are getting creative with incentives, and by creative, we mean desperate. We're talking multiple months of free rent, waived application fees, and even gift cards just to get people through the door. The problem? When everyone's offering concessions, they stop being special and start being expected. Number 7. Atlanta, Georgia. Atlanta isn't just dropping the base, it's dropping rents at an alarming rate. From its peak, Atlanta rents today have plummeted 13.6%, making it one of the most dramatic corrections in the country. The city's affordability advantage drew massive attention during the pandemic. triggering a development frenzy. The metropolitan area added apartment units at an unsustainable pace. Meanwhile, the tech layoffs that hit the city's growing tech sector took some demand out of the market, just as all that new supply came online. If you bought an investment property in Atlanta 3 years ago, you're probably not sleeping well. Properties that cash flowed beautifully on paper are now bleeding money. The combination of falling rents and rising operating costs, including insurance, property taxes, and maintenance, has created a perfect storm of financial stress. Let's hit the heavy hitters now. The next set of cities on our list is experiencing rental market crashes so severe that some landlords are seriously considering selling at a loss. Number 6. Las Vegas, Nevada. What happens in Vegas is a rental market meltdown. Sin City's rents have dropped 13.6% from their peak, falling to a median of $1,443. Turns out the house doesn't always win. Las Vegas rode the pandemic boom hard, with rents skyrocketing as people fled expensive California markets. But the city's economy is still heavily tied to tourism and hospitality, sectors that face ongoing uncertainty. Add in aggressive new construction, and you've got a recipe for rental deflation. Vacation rental owners who converted properties to long-term rentals during COVID are now stuck between two bad options: accept lower rents or go back to the volatile vacation rental market. Many single-family rental investors are sitting on properties that no longer cover their mortgage, insurance, and maintenance costs. Number 5. Denver, Colorado. The mile-high city is experiencing some serious lows. With rents down 7% year over year, Denver tops the list of major metros with declining rental prices. For a city that saw rents surge over 30% 3 years ago, this correction is particularly brutal. Denver's appeal as a hub for young professionals and outdoor enthusiasts made it a development darling. Multifamily construction exploded, with thousands of new luxury apartments hitting the market. The problem? Many of these units came with luxury price tags that fewer and fewer renters could afford as tech layoffs and economic uncertainty took hold. Denver landlords are facing a harsh reality check. Properties that once commanded premium rents due to location and amenities are now sitting vacant or accepting significantly lower monthly payments. The city's high cost of property ownership, taxes, insurance, HOA fees, means these declining rents hit especially hard. Number 4. Cape Coral, Florida. Cape Coral is lately witnessing a year-over-year decline of 6.6% to 8.5%. This southwest Florida city is drowning in rental inventory, and we're not just talking about hurricane flooding. Cape Coral is building apartments at 2 to 4 times the national growth rate, creating an oversupply crisis that's crushing rental prices. The city's relatively affordable lifestyle attracted developers and investors during the pandemic boom. The result? A construction tsunami that shows no signs of slowing. When you're adding supply at multiple times the national rate while population growth remains modest, something's gotta give. And that something is rent prices. Here's the double whammy. Rents are falling while homeowners' insurance premiums are skyrocketing due to hurricane risk. Landlords are getting squeezed from both sides, with many discovering that those sweet purchase prices now look catastrophically overvalued. So here we are, getting into the top 3. The rental market crashes here are so severe, they're making national headlines. These aren't just corrections, they're full-blown market inversions. Number 3. Jacksonville, Florida. Jacksonville has the dubious distinction of posting its largest asking rent price drop since at least 2019, with declines ranging from 6% to a staggering 12.4%. For Florida's fastest-growing metro area, this rental crash is a plot twist nobody saw coming. Jacksonville experienced one of the largest waves of new construction in its history over the past 5 years, with market-rate multifamily inventory growing by more than 20%. The city permitted apartments at a breakneck pace, around 4,628 units currently under construction, flooding the market faster than demand could keep up. The vacancy rate tells the story. Higher-tier properties have seen approximately 2% rent declines annually, while landlords desperately try to fill units. Construction starts fell 61% in the past year, but the damage is already done. Those previously approved projects are still coming online. Jacksonville landlords are living through every investor's nightmare. Properties purchased during the peak time frenzy are now worth less than what's owed on them in many cases. Rents have dropped from a peak of $1,700 in July 2023 to around $1,451 to $1,505 today. A 14% haircut that's obliterated cash flow projections. While rents collapse, landlords are filing evictions at rates higher than pre-pandemic levels. Tenants are struggling, landlords are struggling, and nobody's winning except renters lucky enough to find these bargains. Number 2. Sarasota, Florida. Hold on to your hats because Sarasota's rental market crash is the stuff of landlord nightmares. We're talking about a 42.67% collapse in average monthly rents in the last 20 months, dropping from $3,290 to $1,886. Yes, you heard that right. Nearly half. Sarasota's crash is actually a case study in successful housing policy gone wild. The city implemented aggressive pro-housing reforms, including zoning deregulation, higher density allowances, and a $40 million investment in affordable housing projects. They eased development restrictions, streamlined permitting, and encouraged repurposing existing structures. The result? A flood of new housing that crushed the rental market landlords had become accustomed to. Add in the aftermath of hurricanes that made some property owners, especially those with second homes, sell due to skyrocketing flood insurance premiums, and you've got a perfect storm. Sarasota also reached an 8-year high for housing inventory, meaning the supply glut isn't just rentals, it's the entire housing market. The city went from undersupplied to dramatically oversupplied in record time. Imagine charging $3,290 per month in January last year, feeling pretty good about your investment. 12 months later, comparable units are going for $1,886. That's not a correction. That's a wipeout. Landlords who purchased investment properties in Sarasota during the pandemic boom are experiencing financial devastation. Mortgages that were comfortably covered by rental income are now severely underwater. Some are losing $1,000 to $1,500 per month per property, trying to decide whether to sell at a massive loss or hold on and hope for recovery. The worst part? Operating costs haven't declined. Property taxes, insurance premiums, especially in hurricane-prone Florida, and maintenance expenses continue rising while rental income gets cut in half. It's genuinely brutal. Finally, at number 1, Austin, Texas. Welcome to the undisputed champion of rental market crashes, Austin, Texas. With rents plummeting 22% from their 2-year-ago peak, dropping from approximately $1,800 to around $1,385 to $1,431, Austin's rental market isn't just falling, it's in total freefall. Austin's rental collapse is Economics 101 played out in real time. After experiencing a staggering 25% rent increase in the pandemic era, one of the biggest jumps in the nation, the city became ground zero for a development boom that would make any urban planner's head spin. Here are the jaw-dropping numbers. Austin permitted 64.5 multifamily units per 10,000 people from April 2024 to March this year, the highest rate nationwide. The city permitted an average of 957 new apartments per 100,000 residents between 2021 to 2023, far outpacing every other major U.S. city. Vacancy rates skyrocketed from 3.96% in September 4 years ago to 15.2% by the end of last year. For two-bedroom apartments specifically, vacancy jumped from 3.96% to 9.92% by April this year, while rents crashed from $1,726 to $1,431, a 17.1% decline. The city streamlined regulations and encouraged density, creating an environment where developers could build at unprecedented scale. When the pandemic-era remote work boom brought floods of high-income tech workers to Austin, it looked like the party would never end. But it ended. Austin landlords aren't just struggling. Many are genuinely collapsing. Industry analysts are using words like distress and nightmare scenario to describe what's happening. Real estate experts predict lots of distress for Austin landlords because while rents drop 22%, their expenses spike dramatically. Property taxes in some areas are up 30 to 40% from pre-pandemic levels. Insurance costs continue climbing. Meanwhile, rental income keeps falling. Landlords are offering truly desperate concessions, including 2 to 3 months of free rent, waived administration fees, 600+ move-in credits, discounted renewal rates for existing tenants, free parking, and much more. Major real estate investment trusts, REITs, have effectively written off Austin for the near term. Equity Residential's CEO stated bluntly, "The supply picture is really tough, and there may be a year or so of delay before we kind of re-engage in that market." Camden Property Trust assigned Austin a C- grade, dead last among all their markets. CoStar forecasts that Austin's rents will continue declining through this year. They are only expected to stabilize and start rising again by second quarter next year. The average asking rent should bottom out around $1,557 by the end of the year, which is actually close to pre-pandemic levels. In other words, the entire pandemic rent boom gets completely erased. So what's the bigger picture? What's really happening? These rental market crashes aren't random. They share common threads. The pandemic hangover cities that saw explosive growth during COVID-19 are now experiencing the slide. Remote work triggered a migration boom that developers thought would last forever, but it didn't. The development time bomb apartments take 18 to 24 months to build. Developers who broke ground 3 years ago, at the height of the boom, are delivering units into a completely different market today. They couldn't stop the train once it left the station. The YIMBY success story. Cities like Austin and Sarasota that embraced pro-housing policies are proving that building more housing actually works to reduce prices. Landlords are paying the price, but renters are finally getting relief. The economic uncertainty factor tech layoffs, inflation concerns, rising interest rates, and economic jitters have cooled migration and made people think twice about moving. Nearly every city on this list is in the Sun Belt. The mass migration to warm weather, low-tax states created a construction bonanza. Now the pendulum is swinging back hard. So what this means for 2026 and beyond. Here's the reality. The rental market is undergoing a massive correction, but it's not uniform across the country. While these 10 cities are experiencing dramatic declines, other markets remain stable or even see modest growth. When it comes to national projections, multifamily construction completions are expected to drop to just 250,000 units next year, down from 533,000 a year ago, a 53% decrease, while single-family rents are projected to rise 2.8% nationally. Multifamily rents are expected to increase by 1.6%. If demand remains steady, markets could swing from oversupplied to undersupplied quickly. Most experts predict stabilization beginning at the end of this year through 2026 as construction completions drop dramatically, existing inventory gets absorbed, demand catches up to supply, and economic uncertainty potentially eases. Having said that, expecting a return to 2021 to 2022 levels is a dream. Those were bubble prices driven by unsustainable forces. The market is resetting to more realistic, sustainable levels. If you're a landlord, underwater or bleeding cash, here are your options. Hold on and wait for recovery, if you can afford it. Refinance if possible to lower carrying costs. Sell at a loss and cut your losses. Get creative with tenant retention and property upgrades. And finally, consider converting to short-term or mid-term rentals where regulations allow. For potential investors, these crashes create opportunities for those with strong cash reserves to weather continued volatility, long-term investment horizons of 5 to 10+ years, realistic rent expectations based on current market and not fantasy numbers. Here's the bottom line. The rental market crashes in these 10 cities represent the largest correction in U.S. rental prices since the 2008 financial crisis. Landlords who bought at the peak are experiencing genuine financial distress, with some facing foreclosure or strategic default. But here's the uncomfortable truth. These falling rents are exactly what millions of renters need. After years of crushing rent increases that far outpaced wage growth, the market is finally providing some relief. The pain landlords feel today is the affordability tenants desperately needed. The rental market will eventually stabilize. Construction will slow, demand will catch up, and equilibrium will return. But the era of easy money and guaranteed rent increases? That party's over. Are you a landlord in one of these markets? Buckle up. The coming year will test your resolve. If you can weather the storm, there's likely light at the end of the tunnel. Just don't expect anything unrealistic. So, did you like the video? Subscribe to our channel for latest market updates, investment strategies, and insider insights that'll help you navigate these turbulent times. Because in this market, knowledge isn't just power, it's profit.